Canadians have been waiting 4 years for this day, and that day is where fixed and variable rates both decrease at the same time. It marks the start of rates officially declining, but I would hesitate to say that we're in the clear as of right now due to the fact that we had recent news on inflation and not really the best of news.
In this video, we'll be showcasing today's rates, touching on what's going on south of the border in the States, and putting it all together so it makes sense. It's not going to be a smooth ride, but we're going to be here to guide you through it.
That's right. And if you're new to the show, my name's Tom Moffat, and this is Brandon Love, my good buddy and business partner. And we are both mortgage brokers here in Canada, helping simplify real estate and mortgages.
All right, so let's dive into it.
So before we go into anything, I just want to explain real quick what the difference is between fixed and variable and what they're both hinged on. So whenever you see the headlines in regards to the Bank of Canada and rates, typically we're talking about variable rates because when it comes to the Bank of Canada and prime rate, so the rate that they set, whether they decrease, increase, or keep rates the same, that has a direct impact on variable rates. And so when it comes to fixed rates, those are actually hinged on the bond market, which we're going to touch on in this video as well, because it's important to know that we've actually seen a lot more volatility with the fixed rates, and we're a lot lower with the fixed rates versus where variable rates are at today.
Exactly. And for a long time, it's been very stable in the variable setting. We just had our first rate drop in Canada in June, hopefully, see another one in July. But the bond market has fluctuated wildly. And this is based to any news cycles, for instance, war with Ukraine and Russia, US presidential debates, which we'll touch on in a moment, and other factors like that that all impact the confidence people have in the economy as a whole. So, continuing on that thread, the bond market will react very significantly to the US presidential debate. That's because Mr. Market as a whole prefers to have a president like Trump in office instead of President Biden. So, in that debate, whether you watched it or just read the news headlines, it was pretty clear that Trump was a winner there. Even Biden admitted that he had messed up in the debate, and there's a lot of talk about whether he should step out of the race completely. Now, the extent of my US political knowledge goes back to first year university at McGill, and I've spent the time since then learning more about business than US politics because that's where my interest lies. But I do know that this is a significant momentum swing in President Trump's campaign. Another additional win there came with the US Supreme Court decision. What they ruled is that he can't be prosecuted for acts within his constitutional powers as president. I'm sure that's open to broad interpretation across the board, whether you're liberal, conservative, Democrat, Republican, whatever your worldview is, you probably view things as within his constitutional powers or not within it. That's not our place to decide that. That's up to the lawyers and everyone else who's in that. But it is a big momentum shift for the campaign, and the market reacted favorably to that.
Yeah, and as a result, we actually saw a decrease in the bond yield, which again directly impacted the fixed rates. So we saw a bit of a correction there, or I should say, a decrease in the fixed rates. But on the other side of things, when it comes to the variable rate in the Bank of Canada, not so great of news as we saw the inflation numbers come in at 2.9% for May's inflation number. And that was an increase from 2.7% in April. So, not the greatest news. The consensus was coming in at 2.6. So, obviously, not there. That was mostly due to, I believe, Brandon, correct me if I'm wrong, plane tickets, cell phone plans.
It's usually like plane tickets, phone plans, mortgages, ironically, and
Yeah.
rent. So cost of living is a
Yeah.
huge one, which like it's a double-edged sword because the rates are high, which increases people's cost of living because landlords charge more rent, mortgage payments are higher. So obviously that adds to inflation, but then those inflation numbers stop them from being able to reduce the rates.
Yeah, one thing I do want to point out though that a lot of people have a big misconception on is that they thought due to the Bank of Canada decreasing rates, the prime rate by 0.25 in June, that was the result of why inflation increased. But the inflation numbers are always a month behind. So that was May's numbers. So it had nothing to do with the Bank of Canada decreasing prime rate.
Yeah, and the Bank of Canada, as we saw, is not going to be quick to overreact anymore. I think they learned an important lesson in COVID where they realized they went too far too quick and they put in some of these emergency measures that then just was gasoline on a fire. So they're going to be very cautious. They're going to watch several cycles before you're going to see any major rate changes. So that's a reason why I personally think it's going to go slower than a lot of people anticipate, that a lot of people are hoping for, unfortunately.
Yeah, I agree. Unfortunately, like you said.
With that being said, there's another indicator that also suggests that rates might come down earlier. So you might get the consensus by now that there's indicators pushing things up, there's indicators pushing things down. So it's really up to the Bank of Canada to find that happy medium. We always say in our industry, there's no crystal ball, but we look for indicators to try to determine where the puck might be going. So, one of those indicators is unemployment numbers. And you might think, okay, if everyone's employed, that's really good for the economy and that's really good and rates would come down. It's actually the opposite case. So, high unemployment numbers correlate to lowering rates because businesses are paying less interest, they have more money to add to their numbers. So that's one of those weird indicators where I would think it'd be the opposite way in my like logical brain, but reality is that higher unemployment leads to lower rates. So previous unemployment was at 6.2%. This crept up to 6.4%. So not a huge jump there, but it's trending in a direction that supports a rate decrease.
All right, so now for the fun stuff, we're going to look through the interest rates today in July of 2024. So keep in mind, these are the 5 year term averages on the A side, so not the B side. So there's three different brackets. We have insured, insurable, and uninsured. So insured is simply less than 20% down. You can think of it as when you get mortgage insurance, CMHC, that's insured mortgages. You're always going to have the lowest rate when it comes to insured. And right now, today, we have fixed rates at 4.89%. So roughly a 10 basis points difference from month over month. The variable rate is coming in at 6%. So 0.95% discount. That's the insured rates. We have our insurable. So anything under $1 million for a purchase price, down payment between 20% to 34%. General rule of thumb, the higher the down payment you have, the lower the rate's going to be. So this one's going to come in at a range. We have 4.99% to 5.24%, roughly a 0.05% change from the previous month. We also have our variable rates at 6.3 to 6.15%. That's on average a 0.1% discount from last month. And we have our uninsured bracket. So this is anything over $1 million, or if you're going for that extended amortization to 30 years, you're going to fall into this bracket. It's not going to be covered by the insurers. So you're going to typically have a higher rate. Now, with fixed rates, we're sitting at around 5.29%. So 10 basis points difference. Variable rate, 6.55%. 0.25% difference there. So a pretty big jump there. Keep in mind, these are the posted rates as well on the uninsured side. Sometimes we get it a lot lower than that. And these are the averages too. So for all those of you thinking, well, I've seen lower, you probably have, depends on where you're getting your mortgage, but these are the averages.
Exactly. This is just to give you a good idea of where the overall market is at. There's rate exceptions, there's things we ask for, there's little tricks and strategies we use as brokers to help you get overall lower rates, but that gives you a great idea of how much things have changed. The key thing to really recognize there is that fixed rates are already significantly lower than the variable rates. So those of you waiting for a massive drop in fixed pricing are not going to see it.
Yeah, that's bang on. I think a lot of people don't really understand that it's already priced. So rates have actually fallen quite a bit on the fixed rate side of things. And I don't really see it. I mean, looking at those rates now, we're high fours. Maybe we end up being mid fours, low fours in the next couple of years. So we're not going to see a huge difference there. I mean, obviously, we don't have a crystal ball. We could be wrong there. But like we said, the bond market, the fixed rates are already priced, assuming that we're going to see more drops from the Bank of Canada. So that's why we have a much lower rate on the fixed rate side of things.
Exactly. The only way you would see massive drops there would be some sort of global event. And I don't know about you, but I would rather pay something in the 4% range than be a prisoner in my own home for 2 years.
Bang on.
So the next Bank of Canada announcement is July 24th. A lot of people are hoping for another rate reduction here. I don't think it's going to be a big one if there is one. The reason for this is we, being the Bank of Canada, really need to watch what goes on in the US because if the US doesn't drop and Canada continues to drop, it weakens the Canadian dollar, which then weakens the Canadian economy as a whole. So that's something they're going to be more cautious about. A lot of people described the size of the June rate cut as bringing a butter knife to a gunfight. Great analogy there, but really it's that they don't want to do anything that swings the pendulum too far in the other direction. So they're being overly cautious. I wouldn't expect anything dramatic, but we could be surprised. And if you're shopping for a home, up for renewal, or are just curious about what you can afford, check out the video above. We've put together an affordability video so you can see exactly where you stand. If you want to go even deeper, book a call with myself and Tom, and we will walk you through the finer details.